There is a specific reason why some people get richer while working less, and it has nothing to do with luck or inheritance. It is a single rule they never taught you in school. Everything you've been told about building wealth is probably wrong. You were told to go to school, get a good job, buy a house, and save money. But what if I told you that following that exact path is why you are struggling? Your house is not an asset. Your car is not an asset. And your high-paying job is actually your biggest liability. Most people spend their entire lives trapped in a cycle. We are conditioned from childhood to believe that financial security comes from a steady paycheck. We think that as long as the number in our bank account grows, we are winning. This is the ultimate trap. We work harder to get a raise only to use that raise to buy a bigger house or a newer car. We call these things investments. We tell ourselves we are building equity, but in reality, we're just increasing our monthly expenses. This creates a psychological loop where the more you earn, the more you owe. The middle class is obsessed with looking rich, while the truly wealthy are obsessed with being rich. You see, a high salary only solves a cash flow problem temporarily. It does not solve a wealth problem. If you stopped working today, how long would you survive? For most people, the answer is a few months at best. That is because they have been taught to work for money rather than having money work for them. This brings us to a massive question that most people never think to ask. What is the difference between an asset and a liability? This is the moment everything changes. To understand how to actually build wealth, we have to look at the core principle found in Rich Dad, Poor Dad by Robert Kiyosaki. The central thesis of this book is deceptively simple, yet it is the foundation of every major fortune on the planet. The rich do not work for money. They acquire assets that produce money. Forget the accounting definitions you learned in school. In the real world of wealth creation, the definition is much sharper. An asset is something that puts money into your pocket. A liability is something that takes money out of your pocket. If you can master this one distinction, you can stop trading your time for a paycheck and start building true financial freedom. Let's break this down into practical terms. Imagine your finances as a plumbing system. Most people are busy carrying buckets of water from the well to their house. The bigger the bucket, the more water they have. But if they stop walking, the water stops flowing. Building an asset is like building a pipeline. It takes time, effort, and capital up front, but once it is finished, the water flows even while you sleep. Here at Book Summaries for Self-Growth, we focus on the principles that help you build those pipelines. Think about your primary residence. You pay for the mortgage, the insurance, the taxes, and the maintenance. Every single month, that house takes money out of your pocket. By the core definition of wealth, that house is a liability. Now imagine you buy a small rental property. After you pay the mortgage and the expenses, you have $500 left over every month. That property is putting money into your pocket. That is an asset. This applies to everything in your professional life. A business that requires your physical presence 60 hours a week is just a high-paying job. A business that runs on systems and generates profit without you is an asset. High-value individuals do not focus on their income statement. They focus on their balance sheet. They spend their income to buy assets, which then generate more income to buy more assets. This is the flywheel of the top 1%. Let's look at two different professionals. Person A is a surgeon making $500,000 a year. They have a massive mansion, 3 luxury cars, and a lifestyle that costs $40,000 a month. They are rich, but they are not wealthy. Person B is an entrepreneur who earns $100,000 a year from a portfolio of dividend stocks, a small automated e-commerce site, and 2 rental units. Their expenses are $5,000 a month. Person B is wealthier than Person A. Why? Because Person B has achieved the ultimate goal. Their assets cover their lifestyle. They have decoupled their time from their income. This is how wealth is preserved across generations. It is not about how much you make, it's about how much you keep and how hard that money works for you. At Book Summaries for Self-Growth, we believe that understanding these shifts in perspective is the first step to career and financial growth. Before I leave you with your final challenge, remember that we post every new book on every Saturday to help you stay ahead of the curve. Here is the uncomfortable truth. You are likely spending your best years building someone else's assets while you collect liabilities. Your actionable takeaway for today is this. Open your bank statement and look at every single recurring expense you have. If it's not putting money back into your pocket within the next 12 months, it's a liability. Your task is to find one expense you can cut this week and redirect that money into a small income-producing asset, whether that's a fraction of a stock, a digital product, or a side business. Stop buying things that make you look rich and start buying things that actually make you wealthy.